In our last video, we looked at bonds that were held to maturity. Now, let's take an example and look at how we would treat a bond investment if we were holding it as a trading security, which means we're simply holding it for short-term fluctuation in price. Hills Corporation acquired as a long-term investment $65 million of 8% bonds dated July 1st on July 1st of year 1. Company management is holding the bonds as trading securities. The market value rate yield, or the effective rate, was 6% for bonds of similar risk and maturity. Notice the difference in rate. Our bond yields 8% where everybody else is at 6%. So in this case, we're actually going to have to pay a premium because we're not going to get the 8% return. They're going to price the bond a little bit higher so that it yields us more of a 6% return. So notice Hills paid $68 million for the bond. So this is going to be a bond at a premium. The company will receive interest semi-annually on June 30th and December 31st. As a result of changing market conditions, the fair value of the bonds at December 31st, year 1, was $66 million. Prepare the journal entry to record Hills' investment in the bonds on July 1st. So we're going to go in on July 1st when we actually purchase it. And again, it's going to be the exact same concept as it was with our held to maturity, except this is a premium situation. So we're going to record the investment in bonds at the full face value, $65 million. Then we're going to go in and remember we paid cash for these, so our cash is going to go down, but we paid a premium, so our cash is going to go down by $68 million. So again, we've got a difference here, and in this case we're paying a premium for these bonds, so we're going to debit premium on bond investment. And that would be whatever the premium is, in this case 3. And of course all these numbers are in millions. Alright. So next we're going to prepare the journal entry by Hills to record interest on December 31st at the effective or market rate. So again, we're using the effective rate of interest here. So we're going to go in, and December 31st, we're actually going to record the entry. And again, just like held to maturity, we're going to calculate it the same way. One, we're going to receive cash because we're the investor, so they're going to pay us cash. And again, do you remember the formula for that? It is the face value times the stated rate times the time. Again, time is 6 months, so basically we just take half of the stated rate is the easiest way. So let's do it that way on this one. So that's going to give us, again, our face value is 65. We're going to multiply that by the stated rate. Now I'm going to go ahead and take half of that stated rate. So again, look back. Our stated rate was 8% per year, so that means we're going to have a 4% each period of time. So we're going to go in, and when we look at that and we do, again, 65 million times 4%, that's going to give us the actual interest for this period. And I get 2.6. Again, all these are in millions. Let's put a 0 there so that it'll be nice and even when we get on down here. Alright, so we receive the cash. Again, what is this? This is interest, and since we're the investor, this is interest revenue to our company. And again, do you remember the formula there? It should be the carry value times the effective rate times time. And again, same concept, time is 6/12. So basically just half of the effective rate. And the effective rate, if memory serves me, was 6%. So again, you don't have to put everything in parentheses here. Is just me explaining how we're getting the number. It is not actually part of the account. At this point in time, again, our carry value, you take the investment bond and you net it with the premium in this case. Notice they're both debits, so our carry value is going to be 68 times, and I'm just going to do 0.03, which is half of the effective rate because it's every 6 months. When we multiply that out, we end up with 2.04. Now, wait a minute, it's less than the cash. Well, we expect that because remember, the company is paying us a 8% return per year, but the bonds are priced down to only return 6%. So our revenue from the interest on this is going to be more at the 6% level. So it's going to be lower than the cash that they actually pay us. Now, where does this difference go? Well, just like on a discount, over the life of the bond, we have to amortize the actual premium. So we're going to hit that premium on bond investment for the difference there of 0.56. Okay, and again, these numbers are in millions, not 56 cents here, but it just gives you the picture. You don't need to put all the zeros out through there. Notice these entries are just like the HTM entries. There's really no difference just because it's a trading security. You still purchase it, you still actually record the interest the same way, regardless of the way we classify it. Now, at what amount will Hills report its investment in the December 31st year one balance sheet? Now here's where we get a little bit different. We do not worry, well, we worry about amortized costs, but we don't need to carry the bond on our balance sheet at amortized costs. When you have a trading security, you must carry it at fair value. So for this, we need to go and look up fair value for December 31st. So we look at here and it tells us it's 66 million. So we're going to have to report these bonds at 66 million on our actual balance sheet. Now there's a problem with that. We're currently showing it at amortized cost. Well, what is amortized cost? Well, again, we're going to take our original price, so amortized cost here happens to equal our original cost, our face value of our bond, 65 million, and we're going to net that, and it's going to be a plus in this case because it's a premium, with our actual premium. Now our premium started at 3, but notice we amortized, so we need to subtract 0.56 of that. So if you take 65 plus 3 minus 0.56, what that gives us is 67.44 in amortized cost. So on our balance sheet, that's what it's currently sitting at, is 67. Well, we can't have that. We need to show it at 66. So we need to go in and do what we call an adjusting entry to bring it to our fair value. So on December 31st, we will have to do an adjusting entry. We do this for both trading securities and available for sale to bring whatever that is to the market value of 66. Well, obviously the market value is lower than our amortized cost, so we're going to have what we call an unrealized holding loss on our trading security. Now we do need to note, losses on trading and gains on trading securities for that matter actually go into net income. They will be part of our net income on our income statement. So we need to denote that. Trading securities are net income. So we're going to go in and we're going to hit that for 1.44. How did I get that? Well, 67.44 is our amortized cost. 66 is our fair value. That's a difference of 1.44. Now, how are we going to adjust that? Now, we do not hit the actual investment. Remember, that's carried at face. The premium will be carried at the actual amortized amount of premium, so you don't want to hit that. So we have to create an account called fair value adjustment. And that will, again, be netted with this on the balance sheet to show the fair value of our actual position. So 1.44. All right. Now, suppose KP's bond rating agency upgraded the risk of the rating bonds, and Hills decides to sell the investment for $70 million. In other words, we had a nice little bump up in our actual ratings here as far as this goes, so our value went up, which probably means the market rate went down a little bit. But anyway, what we're going to do is on January 2nd, how would we go about recording the sale? Well, there's two ways we can handle this. So let's go with what our textbook shows, and that is the first thing we need to do is bring our fair value on our books to the 70 million, the amount we're paying. Notice we're carrying it at 66 at this moment. We need to bring that up to actually 70. So the first thing we're going to do is hit the fair value adjustment. Now, how much do we need to do? Well, again, we're carrying it at 67.44 amortized cost. But remember, last time we hit the fair value adjustment for 1.44, we brought that down to 66. We need to take that into account and bring our value for our fair value from 66, what we have it sitting on our books at, up to 70. So we actually need to hit that for 4. Okay, so again, look at that fair value adjustment account. We've got it sitting at the total value of the bond sitting at 66. We've got to bring it from that point all the way up to 70. So in this case, make sure you take into account what you've already adjusted for. Don't simply use the amortized cost of 67.44, because then your bond value would be off a little bit. So you want to bring it up to the full 70. So make sure you include that. Now, this is actually a gain of 4 this year. Now, I know overall we didn't gain a full 4. But this is just for this year because we have to recognize gains and losses in the period they occur. So unrealized holding gain on trading securities. And again, this will show up in the net income, and we're going to hit that for 4. So in essence, the net of the two unrealized holding gains, since they show up in net income anyway, it'll be fine. We'll actually put that in as a gain on trading securities on our income statement. Now, our market value is matching our fair value on our books now. So what we need to do is record the actual sale itself. So when we sell the investment, of course, we're going to get the cash at $70 million. The amount that the purchasing person, again, we're the investor, we're selling this investment on the market, I'm assuming. So we're going to get the cash for it at $70 million. Again, we have to get rid of all evidence of the investment. So we're going to go and we're going to credit the investment in bonds. And again, that was carried at phase 65. Let's put the zeros in here because we will have some points when we get to our premium. We need to get rid of it. So premium on bond investment. And again, at this moment in time, oops, that's actually going to be a debit. Hold on. Make sure I indent. We have to get rid of our premium, so it's sitting there as a debit balance, so we've got to credit that off. And currently we have 2.44 on our bond. And then the last thing we need to do is simply get rid of the fair value adjustment. Notice we're not taking any gain or loss because we've already recognized the gain or loss when we did the adjustments for fair value. So we just need to get rid of the fair value adjustment to net that off. Remember, we had 1.44, then we hit it with 4. So now we need to get rid of 2.56. So if you add these together, you should balance out. So basically, that's an example of an actual trading security, a bond held as a trading security.